All right, so you're buying a house, right? And you want to get a deal. Deal usually means you're getting a lower price than what's offered, or maybe you're getting some kickbacks from the seller, and it's in the form of concessions that you can use for whatever you want, right? Which is better for you. And what should you ask for? Well, it really depends. Sometimes it depends on what you need, depends on the seller. Some sellers don't want to drop their price because maybe they want to tell everybody what they sold their house for, and they're happy with that number. And others may just really care about their bottom line. And for them, a lot of times a price reduction or a credit could be the same for them. But what's good for you as the buyer, right? And what can you do with the money, right? You can do all kinds of things with seller credits. You can pay your closing costs. You can pay down a permanent interest rate. And you could do what's called a 2-1 buy down, or a combination of the two, depending on how much credit you get. But is a seller credit better than a price reduction? Well, I mean, it depends. It really comes down to the individual needs and the property itself and the numbers, right? So let's put in perspective. Let's say you have an $800,000 property, right? That's just what's in my head right now. And let's say you think $15,000 is what the market would get for a price reduction. Well, if you're putting 20% down, what that does for you as a buyer is it lowers your out-of-pocket from the down payment by like $3,000, and that would lower your monthly payment like $80. So you're not really that significant. But if you were to use that $15,000 and not do a price reduction, and you were to use that for, let's say, a permanent rate buy down, that could save you $300 a month. Your down payment would be the same, but you'd save a lot more monthly, and what you'd gain by comparing to a price reduction would be significantly better with a permanent rate buy down. And of course, depends on how long you have the mortgage for. You can also use $15,000 to offset your closing costs, which may or may not be even close to that $15,000. But you can also combine it with what's called a 2-1 buy down. And now this is a little gimmicky. Now, I wasn't always the biggest fan of them, but right now, because rates are a little bit higher than expected, and because many people will probably be refinancing in the next 2 years or so, because rates probably come down, but no one can guarantee, is permanent rate buy down may not be the best, because it would take you about 4 years to make full use of that buy down credit. You see the monthly savings right away, but if you refinance or sell before 4 years, some of that money that was used is kind of wasted. You don't really notice it, but you could have made better use of the funds up front. And 2-1 buy down actually makes use of all the money, same with a credit for your closing costs, although it's not meant to be a long-term solution. And here's what it is. 2-1 buy down is a seller subsidizing your mortgage payments for the first 2 years of the loan. For the first year, you're saving on this scenario about $800 a month. And year number 2, you're saving about $400 a month. And then year 3, your payment goes up to the full amount. Is that better than a permanent rate buy down? Well, short term, I believe it is. But if it's a long-term thing that you're owning the house for, if rates don't come down and you don't refinance, then that's when a permanent rate buy down may be better for you. But dollar amount for the credits is about the same for those two numbers. It just comes down to a review of everything and see what's best for you. Now, what I like about the 2-1 buy down is if you do refinance before the 2 years is up, whatever funds you didn't use to subsidize your mortgage payment comes back to you in your payoff. So it would be reduced in your principal for your mortgage payoff. But if you were to pay it for a permanent rate buy down, that money's gone. I think my personal preference, I like using seller credits, depending on how much they are, really to offset closing costs up front, especially in this market when there's inflation and everything's going up. I like to keep cash available, but everyone's situation is different, and you may prefer a shorter mortgage payment for the first year, and you'd be okay when it fully realizes in 3 years, and maybe you don't expect rates to come down, or maybe you don't care and you just want to get what's comfortable with that. But in that case, you may want to look at a permanent rate buy down, so you'd have a below market rate for the next 30 years, just in case things never come down. It's hard to imagine that rates don't come down, but that would be, if your mindset's there, that could be a good solution. Definitely consult your professional to go over all the options, because everything is subject to change and may not be exactly this by the time you look at the numbers. Good luck. It's crazy out there right now.